So if you're new to the concept of supply and demand, or you kind of understand it, but you don't really understand the theory behind it, we're going to break that down now. Supply and demand refers to price areas in a market where significant buying or selling has taken place. Now this is what we call a demand zone. It's a little box that we can draw on the chart. And what this demand zone shows is an area where significant buying has entered the market. This impulse shows clear buying control from this level up to where the market is now. We know it shows clear buying control because there are these large bullish candles and not really too much in the way of seller or bearish strength. So this shows a very strong push from buyers. Now the demand zone is the area just before this impulsive move. What a demand zone shows is the area where all of this buying began. Now in the flip example where we'd be looking at a supply zone, it's simply the same, but instead we're looking at an area where supply is stepping into the market, so lots more units are being sold in. When we see a area before a large downward move, this shows us that this area of consolidation, this sideways move, this is where the selling has kicked in. So therefore, this is a premium price to sell your assets. If the market gets back to it, we'd be looking for other traders to sell assets at this level, either through obligatory buyback later contracts like short positions or just through profit taking as well. So supply and demand essentially shows prices that buyers and sellers are happy to pay for assets, and what we're looking for is a follow through of that willingness to buy at these levels once the market returns to them. It's very simple stuff. So that's the theory behind supply and demand. The next thing we need to cover is just how we draw these zones. And this one's really quick. For me, I use the last candle before the impulse. So in this example, we can see this is a indecision candle. There's wicks, tiny candle body, no real movement has been made throughout that candle. But the next candle is a very large impulsive candle with clear buying control. The candle body is large. It's made a significant movement one way. That is the impulse candle. So the last candle before the impulse is going to be the one we have marked on here. Now in a selling example, again, it would just simply be the final consolidation candle before the large downward move. That becomes the supply. The reason I look at it like this is because this is the final exact point before major distribution took place. Okay, so that's how I mark them, the last candle before the impulse. Now, like all concepts in trading, these supply and demand zones are sometimes just going to fail. They're not going to work. They're not going to hold. This example, we have a demand zone here. We have another demand zone, which is far beneath, all the way down here. Now this is the last candle before the impulse that still has imbalance into it. So if we're looking for a reversal, we're going to be looking for that around this point. Sometimes, as I've said, these zones simply will not hold. And if we run this market forward, you'll see that the market has pushed through this low. Now what this does is creates what we call a demand fail, which is coming in around this point. And this gives us an indication that this market could potentially be ready to go lower. So this is where demand and supply fails actually become valuable to us. Rather than just losing a trade and not having any other opportunity, what we have here is possibility to now say, well, if this demand hasn't worked, we haven't seen the buying pressure we wanted to see come in here. Now we may go lower towards the next demand, which allows us to then potentially look for short opportunities down to this point, because this demand failing and the ability to push lower that we've seen in the market is showing seller control coming in. So we could look for pullbacks to higher areas of supply. We have two core ones in this range, this one here and this one here. And we may see this as potential to sell down into the area of demand, given that we've seen this first demand fail. And the next logical kind of magnet point for the market to get to and then potentially react from is going to be the lower demand zone down here, okay? So that's something we can actually utilize, take advantage of, and potentially find opportunities from. Now you'll see this market ran all the way up, not reacting to the first zone, but filling the second zone, which could potentially provide a trade in itself. Now, just as a hypothetical position, you could see that let's take a look at that example of that demand fail format in action. So let's say we see this market trading to the upside. We've seen it sweep beneath these relative equal lows just here, and we're looking to buy. We want to take a buy on this market. So we're going to look at the last candle before the impulse, and we're going to use this as our demand area to buy from. So we may be looking for the market to make a little shift to the upside to validate, well, in this case, it's going to be around this structural point, to validate a new high so that we can join this trend. So our current idea is to look for a push higher and then buy on the pullback like this. That is a good way to set up a trade. But if we see the market come down, fail to provide this break up, and actually break to the downside, well, what this does is actually just continues the downward price action that we're currently seeing here. And by failing at this demand, not only do we invalidate the buy, so we manage to get away with no trade here instead of a loss, we actually lead into possible sells. Because if we think about what demand shows, it's that large push of buying from this price level. So therefore we see this price area as the discounted price to buy from. But when the market doesn't react there, it tells us that traders are not feeling that anymore. We're not seeing institutional participants come in with that willingness to buy that they had previously. So what we can actually do is then look for possibility to trade down towards new areas of demand. Now, if we look at these areas here, these have all been retested. Every time we create demand, a wick has come back and retested it. So these are not areas we'd be expecting to see a reversal again, because areas that have already been hit, a demand zone that's already been tapped, is not a demand zone we want to look at. Now, there's more context around that thought in a little bit when we look at how to forecast demand breaks or demand fails before they occur. But for now, the next open demand, the next point with any imbalance, is going to be the demand right down here. We would call this the extreme demand because it's the furthest in the price movement. It's the lowest possible one. So now we have the understanding that given that we've broken through this demand, we are likely to continue trading lower towards the next demand. The demand here has failed. There's no meaningful points between where we are right now and this lower demand, where we're likely to see a new influx of buying. Now, when we consider this demand down here, we know this was seen as a discounted price to buy from, okay? Hence the impulsive move that took place after this small consolidation. Therefore, if we are going to see another influx of buying, it's likely to take place from here, which pretty much leaves an open range from where we are now all the way down there, where there isn't really any pushback from buyers. So what we could actually do here is look at selling the existing supply that we've come into, and we could target that demand zone for a trade. So an idea of a position could be something like this, where what we're actually doing is taking advantage of the fact this demand has failed to hold, and now instead we're looking to continue selling in line with what is currently, on this more refined view, the predominant trend, which is down. And then we would look to take the market down to this demand, get out, and that is where we could look for the next possible buys. Or if we don't get a buy from there and we get a demand fail, well, simply we can look to the left and take a look at lower price areas, which in this chart we have quite a ways down, to identify the next possible point that the market could lead into. So we treat these supply and demand zones as kind of levels for flips, right? Yes, we initially want to buy from there because we are moving with this larger uptrend. But when we see there is no reaction from it, and when we see the market breaking down instead, well, that opens doors to very clear possibility for us to use this as a pretty much forecast or prediction that the market is now likely to go lower. If the market was going to go higher, it would have done so by reacting from demand. But because we didn't see a reaction from demand, and because we've now broken lower, we can continue moving with that overall market flow, that overall direction, and finalize that move to the next demand. And that would be how we trade supply and demand fails. So you don't only have to rely on demand zones to provide the confirmation you want for buy trades, but you can also look at them as a way of providing confirmation if the market melts down instead. Right, now let's